Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello trading cats, I'm the risk manager for the Forex Super Model, and this is part 1, trading and macroeconomic policy. This is going to be a series of economic videos relating to trading, and we're going to start with the objectives of macroeconomic policy. Macro means big, micro small. Think microscope. Macroscope is the opposite, which is a sort of an imaginary cosmos type scope which brings the cosmos closer, and you sort of have this opposite view of it brings large to small, and the microscope brings small to large. Anyway, this is the macroeconomic policy, and these are economic objectives. Now, the problem with economics is that historically it's been known as the dismal science, and this is and the definition of dismal is causing a mood of gloom and depression. Well, we can relate to that here. Now, anyway, as we move on, so the thing you need to realize with economics as well is that one thing leads to another. When you're trying to analyze one thing, you need this informational background to do so, because you're using the language of economics. So we're going to have to start a bit, and we'll try and fill in the gaps. Anyway, without further ado, let's make a go then. So the objectives, the generally accepted objectives of macroeconomic policy, in other words, what governments want to achieve, is number 1 then, stable prices. So they don't want inflation going up and down like a yo-yo. So that's the first one. The second one is they want full employment. Full employment is useful to governments because it increases their tax revenue, etc. And they don't want unemployment because it destabilises the country and is a waste of resources. Right, number 3, economic growth. Generally referred to in trading, we're looking at GDP, gross domestic product, and we're going to have a look in detail at that in a moment. Economic growth then, we'll have a look at some stage in later videos what we mean by economic growth and the whether it's good or bad, etc. Number 4 then, balance of payments equilibrium, X for exports, minus M for imports. So the net effect of your exports minus your imports is your balance of payments. Right, and the 5th one, which is becoming more relevant today, is fair and equitable distribution of income and wealth, which is half rubbed off. So anyway, so this is the sort of situation we're looking at then. So we've got 4 main economic objectives which relate primarily to fundamental data, and that obviously links into the economic calendar, and then you've got this transmission through the economy of data via these objectives, and the 5th one is up and coming, fair and equitable distribution of income and wealth. So we're going to stop it there and then fill in some gaps, so don't go away. Welcome back. Right, in order to understand economic growth and GDP, we need to go back a step and start looking at, in a way, a micro concept, smaller in the economy, and that's called these factors of production. And there's 4, generally believed to be 4 factors of production. First one is land, which is basically a generic term for natural resources. So the sea is viewed as land, it's a resource, lakes, mines, forests, etc. And the reward for having land, if you like, is in economic terms is known as rent. Now, the next factor of production is labour. So this is like basically manpower, women power, whatever you want to call it. And then The reward for labour is wages. And then we've got the third, which is capital, which is man-made style resources, things like machinery, factories, etc. So, and the reward for capital is interest, which we designate R for rates effectively. There's a little bit of notation you'll get used to in economics as well. We don't use I for interest because we use it for investment generally. Anyway, number 4 then, entrepreneurship. This is the process of combining the first 3 factors of production, so land, labour and capital, into some sort of productive unit. The entrepreneur takes the risks and gets the reward, and the reward for entrepreneurship is known as profit, which we designate as pi, the symbol pi in economics normally. Now, again, profit, we don't use a P for profit because in economics we normally reserve P for price, just something to bear in mind. Right, so they're the 4 factors of production, and then we've got this thing called GDP, gross domestic product, at factor cost. Now, a factor cost then equals the market price minus interest, indirect taxes plus subsidies. Now, indirect taxes are taxes like VAT, value added tax. So a direct tax is normally an income style tax which is taken at source. So when you go to work, you have no choice but to pay income tax. It's deducted before you receive your paycheck. So that would be a direct tax. An indirect tax is like an expenditure tax, which is basically optional on discretionary expenditure, like buying petrol for your car, etc. So that's that. And subsidies, we add subsidies. A subsidy then is an allowance from a central organisation to buffer out price. Anyway, so that's filled a little bit of gap in. We now know what factors of production are. They're land, labour, capital and enterprise. We know the rewards for the factors of production, and we know a little bit of what factor cost is. So we'll just stop it there and move on. Right, we're off again. Right, in order to understand gross domestic product, we need to understand what's known as the circular flow of income, how in economics we model the economy, if you like. Now, there are 3 components to this. There's output, expenditure and income. So okay, so what do we mean by that then? So the output of the economy generates the income of the economy, and the income generates the expenditure. So there's like a circular flow. One person's income generates expenditure on the output, if you like. So that's where we are, and this is important because it's the building blocks for the modelling which goes into understanding the macroeconomic system in economic terms, which you will find very useful when you're linking economic calendar data through the system and the transmissions. It takes a little bit of time to get up to speed, but it's worth it. So right then, so as we said, there's a circular flow of income which revolves around output, expenditure and income in the economy, and in economics we say that the expenditure identifies with, and this is this equal sign with an extra equal on it, so it identifies with, so expenditure identifies with income, which identifies with output. What's a simple way of saying it's the same but different? That's what it basically means. In the same way that this economic forum is very similar to the World Economic Forum at Davos, just without the world leaders. So that gives you an idea. So expenditure identifies with income, and income identifies with output, and likewise output identifies with expenditure. You can go round and round, and this is the circular flow of income. Right, stop it there, move on to the next thing. Right, welcome back, cats. Right, we've just said that there's the circular flow of income, which revolves around expenditure, income and output, and we talked about that. We now can explain that there's 3 methods of calculating national income, GDP if you like, gross domestic product, and they're based on those three circular flow of incomes components. So the first method, you can calculate GDP on an expenditure basis or method, and you do this by adding up C plus I plus G plus X minus M. Sounds complicated, but the C stands for consumption, so that's the amount of consumption in the economy. So useful to know, in America, for example, consumption represents about nearly 70% of the economy, so all these things tie in. C plus I, consumption, plus investment then, so that's the investment expending, plus G, government spending, government sector, plus X minus N, exports minus imports. Now if you look at this, we'll talk about this in more detail another time, but you've got, if you have a two-sector economy, which is like households consuming and firms making the stuff, then that would be C plus I, so that's like a two-sector economy. A three-sector economy adds the government, the public sector, so that's the G, and a four-sector full-scale economy adds international trade, exports minus imports. So that sort of factors in. So if you use the expenditure method to calculate GDP, you add C plus I plus G plus X minus M, and that gives you GDP at market prices. Right, moving swiftly on. If you use the income method to calculate GDP, and this is where it was useful to remember about the factors of production, because we've got the self-employed income. We use Y for income, just one of those things. I is used for investment, so we use Y for income anyway in economics. Right. So if we use the income method, we've got self-employed income plus trading profits then. So that's basically the entrepreneur side of it, plus rents, which is interests, and that gives us total domestic income. And if we take stock appreciation from that, and what do we mean by appreciation? Well, depreciation is the opposite side of things. If you buy a car, after a year it's worth less because of time and wear and tear, etc. Depreciation, well, if stock goes the other way and it appreciates, and why might it do that? Well, because possibly you've got inflation in the system or something like that. So that's if you've got stock appreciation. So if you take off stock appreciation, you get a measure of GDP via the income method in the circular flow. And finally, if we look at the output method, then the third method, now the value of firms' outputs is the value of the outputs minus the inputs. Now the problem with that method is you can get double counting, so they tend to use the total of the outputs of the final goods and services, so that avoids the double counting element. So for example, if you use the first method and you count steel to build a car, and then you double count it when you count it as the value of the car at the end of it, that's the type of thing we're trying to avoid in the first method. Anyway, just to summarize then, with the circular flow, you've got expenditure, income and output, which identify together, they're the same but different, and you can actually tap these things off in the economy, in the model, and you end up at the same point. In other words, you end up at a measure of gross domestic product via the expenditure method, the income method and the output method. Right, close it down there, move on to the... Right, welcome back, we're getting there now. So GDP then, this is the whole purpose of the exercise. Gross domestic product as an understanding from the economic calendar or any other economic data then. Gross domestic product at market prices. Remember, this is C plus I plus G plus X minus M. Consumption plus investment plus government spending plus net exports minus imports. So that's a four-sector economy, the full big boy economy. So this is GDP at market prices, and then which is the value of final goods and services produced by the factors of production, FOP, factors of production. And we know what the factors of production are. They're land, labour, capital and enterprise within a country. Now this is the important thing, it's within the country, so it doesn't take into consideration external open issues from abroad. So GDP at market prices is the value of final goods and services produced by the factors of production within a country. Within a country, important. Whereas gross national product, and you can split this into two, you can have this in terms of market prices, which is gross domestic product at market prices. Well, we've just worked this out, haven't we? This is the C plus I plus G plus X minus M. So gross net national product, as opposed to gross domestic product, is GDP, which is the C plus I plus G, etc., at market prices, plus NPYA, and that stands for net property income from abroad. So this is where we broaden it out. So any income that's made abroad is factored into the gross national product, as opposed to domestic within the country as a whole, whereas gross national product takes into account external sources of income. So gross national product at market prices is this C plus I plus net property income from abroad. And then if you do it at factor cost, remember what factor cost is? Well, factor cost is market price minus indirect taxes, things like VAT, plus subsidies. Okay, so gross national product at factor cost equals gross national product at market prices, which is there. So we've worked that out, so it sort of links together, minus indirect taxes plus subsidies, which is what we've said. And the final piece of the jigsaw is net national product, NNP, which is gross national product at factor cost, which we just worked out there, minus depreciation. So depreciation, remember, is the wearing out of capital items. So that is a reduction in assets, if you like. So that's a whistle-stop tour, and basically what it means is when you see I don't know, the German GDP come out, you've got a much better idea of seeing what they're talking about. So we've introduced the concepts of the factors of production, we've introduced the rewards to the factors of production, the circular flow of income, where expenditure, output and income identify with one another, and we've introduced the concept of measuring gross domestic product in this circular flow. So you can there's the three methods. You can use the expenditure, the income or the output method and arrive at a different but the same measure of how the economy is doing. And then we've gone a little bit further and gone into the technical definitions of gross domestic product, which is from within the economy. Gross national product introduces the international element, and then if you take the net national product, is once we've taken off the depreciation from any capital goods, etc. So that gives you a good overview of that's a sort of a starter for 10 for economics. You've actually if you've been awake, you've actually learned quite a lot of information there, which we can then use in the future videos to increase our overall understanding of fundamental data, transmissions through the economic system, and apply these to data flows and data prints in the economic calendar. So I hope you found that useful. See you again for part 2. Thank you very much.